Hi, everybody. This is David Blain, CEO of BlueSky Wealth Advisors. I'm coming to you here today. Just wanted to address what's going on in the markets, as well as obviously in Ukraine, the Russian invasion of Ukraine. For those of you that don't know, my previous career in the military, my area of expertise was actually the Soviet Union, Eastern Europe. Among other things, I speak Russian and studied extensively the USSR. Going to West Point, everybody there studies engineering. Because I went to Notre Dame before that, I had the ability to study other fields, what most people would call a minor. We didn't really have majors and minors there when I went there. But anyway, my minor was in international relations with a specialization in the Soviet Union. And so this conflict is unfortunately something that we've been watching for many, many years. Putin has been on the radar of military intelligence, CIA, for many years as a brutal KGB agent and now the ruler of Russia. And so I just wanted to say that, it's a tragedy what's happening. My heart goes out to those people. I've been in those areas of the world, and to see the devastation and just needless war and destruction is just is terrible. But what I want to talk to you about here today is the effect on us here in the United States. We can talk about whether we should get involved, not get involved, what NATO's role, what their role should be, what it shouldn't be. Some other time, happy to have that discussion. But today, we'll focus on the economic impact of this for us here in the United States. So number one, it's been proven time and time again in my 23 years of doing this. I've unfortunately had to make a fair amount of these videos, or in the old days, write a memo. These type of geopolitical events do not have lasting effects typically on the markets. Markets, global commerce, they are dependent on the fundamentals of the economy, and geopolitical events typically do not have a lasting effect. Here just looking at some different events all the way from World War II, the invasion of World War II. Did you know that 250 days after Pearl Harbor, stock markets were actually up in World War II? JFK assassinated, markets up after 250 days. The oil embargo of the 70s, now that was a little bit different. So remember, that was a recessionary time period. So there was some significant declines in the markets at that time, as well as the events, the 9/11 terror attacks. As you may recall, we were in a recession, 2000, Y2K, all those things. The terrorist attacks came along and it prolonged that recession. But things like the Brexit was another big issue, the Asian financial crisis, the first World Trade Center bombing, Iraq invading Kuwait, those type of things, the markets recovered fairly quickly from them. Of course, the Crimean annexation by Russia previously was a very minor blip in the world. There was a Russian ruble crisis back a few years ago as well that had some effect, but these things typically do not have a lasting effect. As we look at the markets, yes, so far this year to date, 2022, even before the Russian invasion of Ukraine, we had markets declining on the specter of rising interest rates and inflation. Inflation going up, rising interest rates in the short term is bad for markets, and so they reacted to that. But overall, the economy, we have momentum in the markets. The trend is still positive. Certainly a correction of 10, 15% is not unheard of. It's very typical. We've been very blessed and fortunate the past few years. We have not experienced this type of decline very much at all since the great financial crisis. But it's more often than not, it's very typical to see 10, 15% declines every year or so. One of the positive things, investor sentiment, meaning the feeling of participants in the market, is very negative right now, which is it's a counter indicator. So when everybody's negative, that's when you want to be optimistic that the markets are going to turn around. It's just like that. When you get too high of an optimism, markets typically decline. When you get too low, people are too pessimistic is the time when markets typically go up. Also, we have some seasonality in effect. And what do I mean by that? Markets do move in cycles. In the United States, one of the biggest cycles, of course, is our election cycle, the presidential election cycle. And while it's not strong enough to make hard predictions, there is some loose evidence that midterm years, the midterm elections are usually very positive in the second half of the year. Typically, after, as we've seen here, people become disillusioned with the current administration and are all excited to throw them out and get some new group of people in there. And so markets typically react to that in a positive manner. Like I said, it's not a direct correlation, but there are some loose patterns that have existed for quite some time related to that. We also see, fiscal policy. While we're still spending way too much money, I believe it's going to come down from what we've been spending in COVID. The just flooding of the economy with money in COVID has created some fiscal issues. So that's kind of neutral, not positive. We have to get the budget under control again. Monetary policy, as I already mentioned, probably going to be raising interest rates. Doesn't sound like it's going to be overly aggressive. So that's good. We do need to raise the rates a little bit to keep inflation in check, but we don't want to raise them too much to choke off the economy completely. Inflation is a negative. It's running, as you know, very high: food, gas, some of it based on geopolitical events, some based on supply chain issues. And frankly, a lot of it is due to just so much money sloshing around the economy. As most of you know, I'm the chairman of the board of a major health system here in Eastern North Carolina. And, we made money in COVID because so much money came flooding in from the federal government to deal with COVID. It was just too much. There's some estimates that the PPP, the Small Business Loan Program, that a large percentage of that was fraudulent. I know I received deposits into my bank account from the IRS that I don't even know what they were for. Actually, that's not true. I do know what they were for, but I didn't need the money. Why are they sending me money? And there's just a lot of money sloshing around the economy that's leading to inflation. I have to say that they'll make it back when I file my taxes, but anyway, that's another different story. So the macroeconomic environment, the business climate is still very positive. Consumer sentiment wobbling a little bit. I think coming out of COVID, I know here where we live, it really hasn't been much of an effect. I mean, nobody's been shut down here I can't remember the last time anything was shut down around here, but I know some of the other states are still kind of opening up a little bit. So consumer sentiment hopefully will continue to be positive. Corporate earnings are going up, so that's a very positive thing. Some long-term factors, a little bit negative. The valuations in the market are still a little bit higher than we'd like to see. They are correcting, but that's going to be a little bit of a drag on the upward momentum of the market is the valuations. Business cycle is positive coming out of COVID. Things ramping up is very positive for the business cycle. Couple other things that I looked up. Restaurant reservations, which is it's been a big thing, shut down in COVID. It continues to be on the rise. It's an interesting statistic to look at, to keep an eye on that. U.S. consumer net worth. This is what I was referring to with the overstimulation of the economy. Most Americans, now granted, I know there are people out there that lost their job, especially hospitality, restaurants, cruise ships, things like that. But the reality of COVID is that most Americans, not just the 1%, but the 80% in the middle, the net worth of Americans went up all through COVID. And so you add that to all the money that's being printed and put into the economy is causing some of this inflation. But all in all, the Ukraine invasion by Russia should have minimal effect. Just a couple little statistics here. Trade data. Our exports to Russia were just $8.9 billion, or 0.4% of all exports. Our imports from Russia were only 18 billion, or 0.6% of U.S. imports. Of course, some of that inexplicably is oil. We'll talk about that some other time. So minimal impact to the U.S. economy based on our trade with Russia. Our direct investment in Russia was only $12 billion, 0.2% of all U.S. direct investment. Their investment in our country, only about 4.3 billion, representing about 0.1% of all foreign direct investment. On the portfolio side, we, through our ETFs and things like that, do have a very minimal exposure to that. The total aggregate U.S. residents had about 82 billion of Russian securities, 80% of that in stocks through ETFs and things like that. But that amounts to just 0.5% of all foreign holdings. So it's really an insignificant number. Same thing, Russian holdings of U.S. securities, only $4.5 billion. In fact, they liquidated. They own no U.S. treasuries. They used to be one of the larger holder of treasuries, but different sanctions over the years, invasion of Crimea, things like that, they've gotten rid of all their holdings of U.S. treasuries. So the invasion of Ukraine and the sanctions, not really any sort of direct threat at all to the U.S. Now, of course, European Union has a lot more exposure to Russia and the fiscal fallout there. So Russia is only about 1.8% of global GDP, but they do have about 20% of all the world's exports of natural gas and wheat. So companies that get natural gas and wheat from them, as you probably heard, about a third of the gas going to Europe is from Russia, and about half going to Germany is from Russia. Now, the Germans, as we enter the spring here, they should have enough reserves, so it should not affect them significantly the winter, give them time to get alternative supply. Of course, they haven't cut it off yet, but if they do cut it off, the supply, they should be able to get through the winter, have a chance to find some alternative supplies. But that's the big impact is Russian energy exports to Europe that could have an effect on the overall global economy. Okay, so just to summarize here, once again, I want to emphasize the human tragedy involved, a totally unnecessary invasion of Ukraine by Russia. And we need to do whatever we can to support those humanitarian efforts and to prevent such a disaster. As someone who served in the military, who served in places like this, the Middle East, the Bosnia conflict, some places, just the cost of human life and destruction is just completely unnecessary. But as we sit here in our comfortable homes in the U.S. and checking our stock portfolios and things like that, it should not have much effect on us currently as we're positioned. Now, if we get into a shooting war with Russia, as you know, they've put their nuclear forces on high alert. The unthinkable is a whole different scenario. But as we're sitting here positioned today, the U.S. economy especially, and to a large extent, the global economy is still positioned very well, and this invasion of Ukraine should not have a huge impact on the global economy. So if you have any questions, please feel free to get in touch with us. I'm happy to talk about this some more. So thanks for listening, and we'll be making some more videos here soon as the crisis continues to unfold.